For decades, if you wanted to understand the silver market, you had to understand people. We looked at bankers, miners, the long-term holders, and even the regulators. We analyzed human emotions like fear, greed, and the deep-seated distrust that often drives precious metal investments. It was a game of psychology, of trying to predict how different groups would react to news, to price swings, and to economic data. But the game is changing. The next major, earth-shattering move in silver won't be decided by a group of traders in a room or by nervous retail investors. It will be decided by machines. Welcome to the new era of finance. The markets today aren't what they were even 10 or 20 years ago. They are dominated by algorithmic and high-frequency trading systems, often called HFTs. These are sophisticated computer programs that execute the vast majority of all daily trading volume. We're talking about systems that operate in milliseconds, a speed that the human mind can't even comprehend. They process enormous amounts of data, news feeds, pricing data, order books, economic reports, and they act on it instantly, without a shred of emotion or a moment of hesitation. There's no fear, no greed, just pure, cold logic. For more than a decade, the algorithms trading silver were built around a very specific framework: mean reversion. The core instruction was incredibly simple: sell the rallies. Every single time the price of silver started to climb, every time it pushed above a key technical level like a moving average or a resistance point, this automated selling pressure would kick in. The machines would flood the market with sell orders, primarily through futures and derivatives contracts. This had the effect of constantly suppressing momentum. Anytime silver looked like it was about to break out and start a real bull run, the algorithms would step in and push it right back down. It was a predictable, profitable strategy for these big players, but it kept a lid on silver's true potential. But here's the critical part: the reason why everything is about to change. That framework, that decade-long strategy of selling every rally, is now breaking down. We are seeing the first cracks in the dam, and it's happening at the institutional level. Recent positioning data, specifically from the Commitment of Traders report, shows something unprecedented. US banks, which have historically held massive net short positions in silver, essentially betting that the price will go down, are now shifting to net long exposure. They are flipping their positions. They are now betting that the price will go up. This isn't just another piece of news for a human analyst to ponder over a cup of coffee. This information is data. It's a signal, and it's ingested instantly by these institutional algorithms. They use advanced techniques like web scraping and natural language processing to scan every report, every news release, every data point the second it becomes available. When these machines detect a structural change of this magnitude, the commercial players, the smart money, flipping their entire market bias, they don't interpret it subjectively. They reclassify the entire market regime. In the language of data science and probability, this represents a critical state change. Think of it like water turning to ice. It's not a gradual cooling, it's a phased transition. The fundamental properties of the system change. In the eyes of the algorithms, silver is no longer being treated as an asset to fade on strength, an asset to sell whenever it rallies. It is now being reclassified as an asset to accumulate on weakness. The primary instruction is flipping from sell the rally to buy the dip. And when this transition happens, it is not slow, it is not gradual, it doesn't happen over weeks or months. Algorithms execute their new instructions immediately. The moment the new classification is made, the buying programs are activated. This creates a sudden, massive surge in demand. Simultaneously, the old selling programs are turned off, which means liquidity on the sell side dries up. You have a huge new source of buyers chasing a dwindling number of sellers. This is the perfect recipe for a price explosion. This is the key difference between human markets and machine markets. A human trader might see this data and hesitate. They might second guess it. They might wait for confirmation or worry about being wrong. They might have a bias from the last 10 years of trading. Machines do not hesitate. They do not have biases. They do not get scared. They simply act on the new data and the new probabilities. The switch has been flipped, the code has been rewritten, and the machines are now programmed to buy. So, while many are still watching the old indicators, trying to guess the sentiment of human traders, the real story is happening in the servers and data centers of the world's largest financial institutions. The signals have changed, the algorithms have adapted, and the buying has likely already begun. The era of machine-driven silver accumulation is here, and it's going to be faster and more powerful than anything we've seen before. The next major move is not a question of if, but a matter of milliseconds. Thanks for watching, and be sure to subscribe for more insights into the forces shaping our financial world. Have you ever wondered what would happen if the entire financial market tried to do the same thing at the exact same time? It sounds like a scene from a movie, but it's happening right now in the silver market, and it's being driven not by humans, but by algorithms. Welcome to what I call the algorithmic super spike. Picture this: the market opens under a completely new set of rules, a new regime. Suddenly, every automated trading system, every piece of algorithmic capital, realizes it's positioned incorrectly. They all need to reposition, and they all need to do it now. This simultaneous scramble for the exit, or rather, the entrance, creates something terrifying and powerful, a liquidity vacuum. Imagine you're trying to buy something, but everyone else wants to buy it too, and no one is selling. That's what's happening. Sell orders for silver are just disappearing. They're being pulled off the market or filled instantly. As a result, the price doesn't just tick up, it gaps higher. It jumps from one price level to the next, leaving a void in between. This isn't your typical, gradual market climb. This is a violent, explosive move upward. Now, let's look at the other side of the coin. Think about the massive hedge funds and institutional players. For them, there's a risk far greater than losing a bit of money on a bad trade. It's the risk of being left behind. In the world of institutional finance, failing to participate in a major market move, a historic trend, is a career-ending mistake. It's called tracking error, and it's the fear that keeps fund managers awake at night. If the market is soaring and your fund is sitting on the sidelines, your clients will want to know why. Being wrong is one thing, being absent is unforgivable. So, what do their algorithms do when they detect they are underexposed to this skyrocketing silver trend? They don't just cautiously start buying. No, they switch into what can only be described as an aggressive catch-up mode. These algorithms are programmed to get exposure at any cost. Their directive is simple: buy any available liquidity, regardless of the price. They aren't looking for a bargain. They are desperately trying to get on the train before it leaves the station for good. This creates a relentless price-insensitive buying pressure that just keeps pushing silver higher and higher. But this is only one part of the equation. A market needs two sides, buyers and sellers. We have this insane, algorithm-driven demand. But where is the supply? This is where the situation gets truly unprecedented. The traditional sources of silver supply have completely dried up. Think about who usually sells in the past. You'd have big banks selling to manage their positions or take profits. Not anymore. They've recognized the shift and are holding on. What about long-term investors, the so-called strong hands who have been accumulating silver for years? They aren't selling either. They've been waiting for this moment. They see this price action not as an exit point, but as validation of their entire thesis. They're not distributing. They're holding tight, or even adding to their positions. And what about the most fundamental source of new supply, mining? Silver mining output is a slow, difficult process. You can't just flip a switch and double production overnight. It takes years to develop new mines, and current output is already constrained by geological, logistical, and economic factors. So, new supply is basically fixed, a mere trickle against a raging flood of demand. The result of this dynamic, insatiable, algorithmic demand crashing into a wall of non-existent supplies, a one-sided market. There are only buyers. The price discovery mechanism is broken because there's no other side to discover. The price just goes wherever the last, most desperate buyer is willing to pay. This isn't a negotiation. It's a stampede. Now, let us layer on the next set of algorithms that pour gasoline on this fire. Momentum systems. These are some of the most powerful forces in modern markets. Trend-following algorithms are designed to do one thing: identify a trend and ride it. They don't care about fundamentals. They don't care if an asset is overvalued. They only care about price direction. As silver prices rise, these momentum systems receive a clear signal: uptrend detected. Their programming then compels them to add exposure, to buy more. The more the price rises, the more they buy. The more they buy, the more the price rises. It's a powerful, self-reinforcing feedback loop. Each new high triggers another wave of automated buying, which creates the next new high. This is how trends go from being strong to being parabolic. The machine is feeding itself, and the momentum becomes almost unstoppable. But it's not just about price. Let's talk about the information landscape. This is where sentiment analysis engines come into play. These sophisticated algorithms don't look at charts. They read the entire internet. They scan millions of news articles, social media posts, forum comments, and engagement data every second. They're looking for shifts in human emotion and attention. Right now, what do you think they're detecting? They're seeing an explosion of bullish participation. They see the word silver trending. They see engagement metrics on silver-related content going through the roof. They measure the tone of the conversation and find it overwhelmingly positive. These systems aren't designed to be contrarian. They don't fight the crowd. They are built to anticipate the crowd and front-run it. When they detect this rising tide of bullish sentiment, their response is to buy before the rest of the human crowd piles in, further accelerating the price move. They are literally turning social media hype into pure buying pressure. And here's perhaps the most significant piece of the puzzle: the clue that this isn't just another rally. The old rules are breaking. For decades, silver's price behavior was defined by its correlations to other assets. When the US dollar went up, silver usually went down. When interest rates rose, silver, as a non-yielding asset, typically suffered. These were reliable, almost textbook relationships. Those correlations are now shattering. We are seeing silver rise even when the dollar is strong. We are seeing it climb despite shifts in interest rate expectations. This decoupling is a massive signal to the algorithms that something fundamental has changed. The old models are obsolete. The market is in the midst of a regime change. When a regime change happens, algorithms have to throw out their old playbooks and write new ones. They start repricing silver under entirely new models. Instead of treating it like a boring monetary metal tied to the dollar, they start modeling it like a high-growth technology stock or a pure momentum asset. The valuation metrics change completely, and the new price targets calculated by these models are dramatically higher than anything the old models could have justified. The machines are literally recalibrating the definition of what silver is worth. Finally, we have the global arbitrage systems. These are the super-fast algorithms that ensure the price of silver in London is the same as it is in New York or Shanghai. They are the market's plumbing. But in a volatile gapping market like this one, their function becomes an accelerant. When a price gap opens up between different global exchanges, even for a millisecond, arbitrage bots jump in to exploit it. They will instantly buy on the cheaper exchange and sell on the more expensive one, forcing the prices to converge upwards. In this one-sided market, this mechanical process doesn't just smooth out prices, it aggressively transmits the upward momentum from one market to the next. Around the clock, if a buying surge happens in Asia overnight, by the time Europe opens, the arbitrage bots have already forced prices higher to match. There is no escape from the upward pressure. So let's put it all together. This isn't a story about a few traders getting bullish on silver. This is a story about a complex, interconnected system of automated processes all firing in the same direction. The initial liquidity vacuum, the institutional fear of missing out, the non-existent supply, the self-feeding momentum loops, the sentiment-treating AI, the breaking of old correlations, and the global arbitrage bots. They are all part of one giant, automated machine that is discovering a new, much higher price for silver. This is no longer discretionary trading based on human opinion. It's automated price discovery on a scale we've never seen before. It's systematic, it's relentless, and it's likely just getting started. The algorithmic super spike is here. Thanks for watching. If you found this breakdown insightful, make sure to hit that like button and subscribe for more deep dives into the forces shaping our markets. See you in the next video. Have you ever watched a market go completely vertical and wondered what on earth is going on? It's not just hype, and it's not just a bunch of people suddenly deciding to buy at the same time. What you might be witnessing is something far more powerful, something mechanical and almost unstoppable, a gamma squeeze. And right now, the silver market is showing all the classic signs. Let's break down exactly what that means and why the machines are taking over. It all starts quietly. As the price of silver begins to gain some momentum, a new kind of activity starts bubbling up beneath the surface, specifically in the options market. This is where the big players, the speculators, and the systematic funds, essentially advanced trading algorithms, begin to make their moves. They start accumulating call options, which are bets that the price of silver will go up. But they're not just buying any call options. They're targeting strike prices that are higher than the current market price. Think of it as them placing bets on future, higher price levels. Now, here's where the magic, or the mechanics, really begins. For every option someone buys, someone else has to sell it. Often, these sellers are large financial institutions known as market makers. Their job is to provide liquidity, to always be there to take the other side of a trade. But they aren't in the business of gambling. When they sell a call option, they are now short that option, meaning they could lose a lot of money if the price of silver skyrockets. So, what do they do to protect themselves? They hedge. To offset the risk of those call options they sold, they are forced to buy the underlying asset itself, in this case, silver futures. Initially, this hedging is manageable. If they sell an option at a strike price far from the current price, they only need to buy a small amount of silver futures. But this is where a powerful force called gamma comes into play. Gamma measures how quickly their hedging needs change as the price of the asset moves. And here's the crucial part. This relationship is not linear. As the price of silver gets closer and closer to those higher strike prices where all the call options are clustered, the market makers' need to hedge explodes. Their risk management systems, which are all automated, start screaming at them. They are compelled to buy more and more silver futures, not because they think silver is a great investment, but because their models demand it to control their risk. This creates a powerful, self-reinforcing feedback loop. The rising price of silver forces market makers to buy more silver futures. This massive buying pressure pushes the price of silver even higher. This higher price then forces them to buy even more futures to adjust their hedge, and the cycle repeats, faster and faster. Rising prices force more buying, which forces prices higher still. This is the essence of a gamma squeeze. In this kind of environment, human judgment, emotion, and fundamental analysis are thrown out the window. A dealer at one of these big banks isn't sitting there thinking, wow, I really believe in silver's long-term potential. No, their risk management systems are flashing red, compelling them to execute trades. They buy because their exposure demands it. Stability completely evaporates, and volatility begins to feed on itself. It's not about what a human thinks. It's about what the machine is programmed to do. The system is designed to prevent a catastrophic loss for the institution, and in doing so, it pours gasoline on the fire of the rising market. Then, another critical element comes into the picture: price history. Markets tend to have memory, with certain price levels acting as strong resistance, where selling pressure has historically been intense. But what happens when a gamma squeeze is so powerful that it breaks through these long-standing historical resistance levels? Once we're in uncharted territory, above those old highs, the market structure changes dramatically. The order book, which shows all the buy and sell orders at different prices, becomes very thin on the sell side. There are very few people who have orders waiting to sell at these new record high prices. This lack of sellers creates a liquidity vacuum. When there are no sellers to absorb the intense buying pressure, prices no longer move incrementally, ticking up cent by cent. Instead, they gap higher. They jump through these empty zones in the order book, creating that shocking vertical price action you see on the charts. It's not a gradual, healthy appreciation. It's a violent, mechanical repricing event. The market is literally skipping over price levels because there's no one there to trade at them. This is when the different waves of participation begin to unfold. The first wave is the algorithms, the systematic funds that initiated the process. They are the smart money, the ones who saw the setup and positioned themselves early. The second wave is the institutional players. These are the larger hedge funds and asset managers who might have been watching from the sidelines. They see the momentum, they understand the mechanics of the squeeze, and they jump in to ride the wave, adding even more fuel to the fire. Finally, the third wave arrives. The retail investors. This is you and me, the general public. We start seeing the headlines. Silver prices explode. Silver hits new all-time highs. The fear of missing out, or FOMO, kicks in. Everyone starts talking about it, and the public piles in, reacting to the news and the incredible price chart. The irony is, by the time public attention peaks and the story is on every news channel, a significant portion of the move has already happened. The earliest, easiest gains have been made by the machines and the big institutions. At this stage, you'll start hearing a new narrative emerge. The media, which was just celebrating the new highs, will start talking about irrational exuberance, excesses, and market bubbles. They'll warn of a coming crash. But this narrative often misses the point. While the market is certainly stretched, the price behavior isn't just driven by emotion anymore. It continues to be driven by the underlying structural scarcity of available silver and the relentless, mechanical buying pressure from the gamma squeeze. And let's be clear about the role of technology here. Artificial intelligence and complex algorithms are not creating this trend out of thin air. They are not inventing a reason for silver to go up. What they are doing is accelerating it at a speed and scale that is almost impossible for humans to comprehend. These systems don't care about the history of money, industrial demand, or the intrinsic value of a precious metal. They are not sentimental. They respond to a cold, hard set of inputs: probability, order, flow, and momentum. They analyze the flow of buy and sell orders. They calculate the probabilities of price movements, and they ride momentum. And right now, all of that data, all of those inputs, are pointing in one single direction: up. This is not a market driven by emotional panic or manic buying from the public, at least not in its initial most powerful stages. It is a market driven by cold, hard, mechanical execution. The machines, with their automated risk models and momentum-chasing strategies, have all aligned with the trend. They are buying in unison, not because of a shared belief, but because their programming dictates it. The squeeze is underway. The feedback loop is engaged, and as long as the price continues to press higher toward those key option strike prices, the mechanical buying is set to continue. This is what a modern market looks like when the machines take control. It's fast, it's brutal, and it waits for no one. So keep an eye on this market, because you are watching a truly fascinating, and potentially historic, event unfold in real time. Thanks for watching, and be sure to subscribe for more deep dives into what's really moving the markets.